Time for our second guest, and we're going to get a balance now on the share side of things, because actually delighted to introduce to the programme a director from the Thornton Group, Duncan Wiech. Duncan, welcome to the show.
Thank you, thank you.
And I know you were cringing a little bit with Streetwise there, because not everyone was going for shares, but I'm sure we'll get your balance for you just shortly.
Well, I think basics first. Tell us a little bit about what a stockbroker does.
The stockbroker, the role of the stockbroker has changed in many ways over the last probably 50 years with the introduction of the internet. People now, if they just want to buy a stock, can go on the internet themselves and just effect a transaction. I think the stockbroker now has more a coaching role and a portfolio management role than they once did.
Yep.
So it's a way of accessing the share market, but knowing what stocks to buy, what proportion of stocks, and what the clients really want.
It is interesting what the internet has done for people in all sorts of facets of our lives, isn't it? Basic question, but why, obvious question, why do people invest in shares, and what are the benefits?
Oh, it's all about the money. It's all about the money.
Mike Arnold's in the studio still on you. It's about the money.
As soon as you write it, I was once taught, as soon as you write a cheque, you've created a risk. So you've really got to get a return back on your money. The share market consistently, and I know we'll probably have debate on this, but consistently outperforms all other asset classes. So it is a true reflection of what's actually happening in the economies now. So if our economy is doing particularly well, our companies do particularly well, shareholders do particularly well. So I guess that underpins the whole reason why we're there.
It's about the money.
It's about the money.
It sounds like it's
all about the money.
For people investing in shares at the moment, but I believe there are some kind of risks involved. What would they be?
Losing money.
Well.
Losing money.
Check bouncing.
And I guess the real reason behind that is buying probably the wrong stocks, probably buying them at the wrong time. When things are too good to be true. They usually are, so people want to get on the bandwagon. I guess it's the Me Tooism that flow through the market, and I guess people don't truly understand why they're buying or what they're buying and the risks associated with it.
I'm going to explore that a little bit more if I could, because clearly there would have been a lot of people caught up in the recent disasters that would consider themselves fairly educated people in investing in stocks and shares, and yet still lost. So what risks are there? Clearly there are risks because people did lost. What steps, I guess, can you make to minimise those risks?
I think the first one is understanding what your tolerance of risk really is, Simon. A lot of people are very aggressive when the markets are doing particularly well, only to be the first to squeal when the markets start to fall. So I think it's your tolerance to risk, or the tolerance to risking capital is the first thing you need to address and understand those risks.
And that's something that you do at the outset, understand someone's risk profile and put them into something that suits that.
Very much so.
I guess. And ask the questions about, because I know there's money involved, and you mentioned money, what about the costs associated with selling shares? I guess selling and buying shares should be the question.
Yeah, that's evolved as well over the time, I guess, with the introduction of the internet. If viewers want to do it at home, they can do it on the internet themselves. So that can be quite cheap, of the order of $30 to $40, I believe. If they use a broker, the broker can charge a brokerage, and that can be anywhere up to 1.5% of the value of the trade. Or alternatively, I think the industry is starting to move more now into the management of the portfolios, where the broker himself takes a fee as a percentage or on a time basis allocated to that portfolio.
And does that, if you're doing it over the internet, does that mean you can do it as many shares as you want, and it's that kind of single fee, or does it up and down depending on how many?
Over the internet, it's per transaction. It's per transaction.
So just going back, and it feels like a three-shell thing.
That's good.
But just going back to where you talked about how brokers do charge at the moment. It's a brokerage fee. You were there talking then about sharing in the success, potentially, that they would, rather than charge a brokerage fee, be paid on the earnings.
Yeah, it can work out. For instance, if you're doing it, I guess hypothetically, a $10,000 trade, the cost of it, the minimum broker will charge generally is, say, $75, $80, and maybe upwards to $150 on that $10,000 trade. And the disparity in the pricing would reflect the amount of research the broking house has done to try and arrive at that decision.
But of course, if you do it over the internet, I guess the worry is you don't have the experience of a stockbroker in, giving you the advice on what you're going to share in. So, I'd probably pick the stockbroker.
And we touched on it a little earlier as well, lots of educational seminars on the property side of things. I know there are educational seminars out there in the stock market, and, correct me if I'm wrong, but there's that much software out there these days that people can just buy and plug in, thinking that now they're going to uncover the world's great wealth.
It's really strange because the market's not a perfect science.
Yeah.
So unless there's the perfect algorithm to reflect actually what's happening, I find those programs a little difficult.
Okay.
Difficult to accept.
Now, what I want to know is, do you have to own shares for any certain amount of time, or can you just basically sell and buy like that? Not that would
it's a big range really, because there's those people that can own it for 5 minutes, buy a stock and trade 5 minutes later.
Right.
And they're what you've probably heard of the day traders. They come in at the beginning of the day, go at the end of the day and make their profit or cut their loss.
They're like superheroes.
So, yeah, well, the alternative is the investors and those that accumulate and those that buy good stocks.
Okay.
Yeah, so it varies. It can be, some of our clients hold stocks for 50 years.
Oh.
Other of our clients own them for 5 minutes. So
but as a day trader, if I can just elaborate on that, what if there's no buyer for your stock at the end of the day?
That is the scariest thing you'll ever see, if you own a stock and no one wants to buy it. So, yeah, it can happen. Global financial crisis, October 2008.
Okay. We're touching it with Mike, research. How much research stroke training should a person do prior to investing in shares? Or is it one of these things, you've just got to get in and do it and dip your toe in the water?
I think the best advice I can give your viewers is to have some parameters to understand what you're investing in it and why you want to invest in those particular stocks. At our company we have an understanding of A, how the economy is, B, what type of company we're looking for, and that can be a company that has a dominant position in its market, a proven board that consistently makes great decisions, that continually drives profit, that continually pays good dividends, and also one that you can actually see a direction that the company's likely to head. They're the ones that we basically set up rules like that, and I would strongly recommend that your viewers do the similar thing. Too much information is confusing, too little is stupid.